I want to thank our witnesses testifying today, both in person and remotely. And I want to again thank my colleague, Senator Lummis, for your partnership and joint work on this subcommittee hearing. So everyone wants a safe, decent place to call home. And without this, nothing in your life works. Not your job, your health, your education, your family, not anything. So when parents hear that there might be a way for them to buy a home for their families, something that had previously seemed out of reach, we can understand what that would be like. Safety and security, an opportunity for a better school for their kids, to live closer to work, maybe a backyard or an extra bedroom for their family. And this is the American dream, and it is also the way that most people build wealth and grow a safe, secure life. So this subcommittee hearing today is about how this dream is being exploited by unscrupulous home sellers under the guise of offering home ownership through complex contracts. Instead of a traditional mortgage, they sell homes on an installment plan with a high-interest loan called a contract for deed or a land contract. These contracts go by different names in different places, but what they all have in common is that they provide all of the risks and few of the protections homeowners can expect under traditional mortgages. The buyers of these contracts are often faced with extraordinary penalties if they miss even one payment. People think that they are on the path to owning their own home when in fact they are on a path for financial disaster, forfeiting all of the money that they have paid in as well as the place that they thought was their home. Too often, these contracts are designed to fail. So I became interested in this issue when I learned about how these land contract sellers are targeting people in my home state of Minnesota, particularly Somali Muslim immigrants, who, under the tenets of their faith, are limited in paying interest with a traditional mortgage. The stories that I've heard are heartbreaking and enraging. Families targeted and exploited because of their religion and their inability to get access to a traditional mortgage. And as we did more research, we learned that unscrupulous contract for deed sellers are operating across the country. Typically, they're targeting Black and brown and immigrant communities, poor communities, groups that have long suffered from housing discrimination. It's estimated that there have been more than 3 million homes sold with land contracts across the country, affecting people in all parts of the country in all states, not only Minnesota, but also in places like Ohio and Texas and Georgia. So our purpose with this hearing today is to understand how these land contracts work, how they differ from traditional mortgages, why their use is apparently expanding, and what all this means for people caught up in this web. But as a start, we know that many of these land contracts lack basic consumer protections. And I know that our witnesses will tell us more about this during the course of this afternoon. It's important, I want to add, to understand that land contracts or contracts for deed and similar financing mechanisms have been around for a century or more. And when used properly, they are a legitimate tool for financing real estate transactions. In recent years, some nonprofits have launched innovative programs using land contracts, coupled with housing counseling and reasonable contract terms, which can help families buy homes for the first time. And I commend the organizations who are using land contracts as tools for good. But land contracts also have been historically a tool for housing discrimination and exploitation of poor communities and communities of color who could not get access to traditional banking and mortgage products. And today, these buyers still have a hard time getting access to credit, so the legacy of discrimination lives on, including in my hometown, where the disparities between white and Black home ownership are the greatest in the nation. So today, we're going to dive into this issue with this excellent panel of witnesses. We want to understand how this is happening, how prevalent the problem is, what impacts it has on families, and what Congress should consider as we think about basic consumer protections, and how to address the root causes of lack of access to capital and lending so that every family has a safe place to call home. I want to commend my ranking chair here today because I know that she has spent a lot of time thinking about what we need to do to expand access to capital and borrowing and lending in fair ways. And so I very much appreciate your shared work on this. So thank you, Senator Lummis. Thank you for working with me on this hearing, and I now recognize you for your opening statement.
Well, I want to thank the chairman as well. This issue, I think, is critical in your state and critical in the Midwest, maybe even more so than the Mountain West where I live. But you mentioned something already that I had not thought of, which is the effect of certain religious practices and usury laws that run counter to their religious beliefs, encountering the financial system that we have in place in the United States. So lots to learn on my part. I want to thank our witnesses for helping instruct and inform and provide wise counsel to this committee. So welcome, witnesses. And thanks again, Madam Chairwoman. Buying a home is a critical part of the American dream. Because of higher prices and higher mortgage rates, this dream is out of reach for an increasing number of Americans. That's certainly true in my state of Wyoming. I hear weekly from Wyoming people that are struggling to find a foothold in the housing market. While current homeowners can use their home's equity to trade up in the housing market, first-time home buyers are finding themselves largely priced out of housing markets. So I think it's important that we talk about how we can get past this and find alternative housing financial products like land contracts and lease-to-own agreements that have fewer hurdles and that don't protect consumers adequately. Compliance costs for banks have increased since the great financial crisis, and the fixed costs of underwriting have risen, hitting consumers that need to borrow a relatively small amount the hardest. This hurts low-income and rural home buyers the most. And while it's not clear how many households use land contracts or contracts for deed, it's not surprising that anecdotally their use has increased since the great financial crisis. More recently, rising mortgage rates have also pushed home buying further out of reach for many families. And Congress shares some of this blame. The Congress, both under the last administration and under this one, has been embarked on an irresponsible spending spree. The Fed's been forced to raise rates to combat inflation, and as a result, mortgage rates have also risen. The median family in Wyoming has an income of about $65,000 each year. When mortgage rates were at 3%, this family could afford to purchase the median home in Wyoming at $280,000 with a modest down payment. With rates closer to 7%, that family can now only afford a $200,000 home. So this loss of purchasing power has been felt most acutely by the families that have been saving for years for a down payment, only to discover a house is even farther out of reach. So now's the time to think creatively about how to help families purchase their first home. Financial products and tools to build wealth and accomplish goals are necessary. Let's explore them. Families need access to a variety of financial products and the flexibility to select the one that would best suit their needs. They also need to understand the trade-offs between various products and have the information they need to make the best decision for them, for their families. So our witnesses today come from states that use a variety of laws to govern land contracts. While data on the use of land contracts is thin, there are regional variations in their usage. States have exercised their oversight of consumer protection to do what's best for the citizens of their state. Let's explore which states are doing it the best. Let's find best practices. State governments should continue to evaluate how to ensure households can make informed decisions and how to protect consumers from fraud. Finally, the clearest way to make housing more affordable is to make more housing, period. We need to reduce barriers to building more houses so that more households can realize their American dream. Thank you, Madam Chairman, for holding this important hearing and inviting witnesses that can elucidate this issue.
Thank you so much, Senator Lummis. I will now introduce our three witnesses. We have Sarah Bowling Mancini, who is a senior attorney and co-director of advocacy, at the National Consumer Law Center. She is a leading expert on foreclosures, mortgage lending, and credit reporting issues, and has represented homeowners in federal and state courts. She holds a law degree from Harvard Law School. Joining us remotely will be Beth Goodell. Ms. Goodell is a supervising attorney of the Consumer Practice Group at Mid-Minnesota Legal Aid. She leads a team of legal aid attorneys who have litigated contract for deed cases on behalf of low-income Minnesota families. She has been a legal aid lawyer for more than 25 years and holds a law degree from Penn Law School. And we have John Green joining us today, who is managing principal at Black Star Stability. Black Star Stability's distressed debt fund's aim is to achieve compelling returns for investors while providing significant benefits to low-income and moderate-income families by reducing distressed mortgages and land sale contracts. Mr. Green has more than 18 years of real estate and financial experience and has managed approximately $5 billion in properties. He has an MBA from Harvard Business School and an MPA from Harvard's Kennedy School of Government. We will begin with Ms. Mancini and then turn to Ms. Goodell and then Mr. Green. For each of our witnesses, you will have 5 minutes for your opening statements. There's a clock in front of you to help you gauge the time. And of course, your full written statements will be a part of the record. Ms. Mancini, you are recognized for your opening statement.
Thank you. Chairwoman Smith, Ranking Member Lummis, and members of the committee, thank you for the opportunity to testify on behalf of the low-income clients of the National Consumer Law Center regarding alternative home purchase methods. My name is Sarah Mancini, and I am co-director of advocacy for the National Consumer Law Center based in Atlanta, Georgia. Zachary Anderson was in his early 50s and was working as a city mechanic when he saw signs dotting his southwest Atlanta neighborhood advertising homes for sale with low down payments and low monthly payments. He called the number on one of those signs and was told to sign some papers and FedEx them back to the company Harbor Portfolio. He got a letter that said, "Congratulations on the purchase of your new home." Mr. Anderson had no idea that the transaction he entered into was any different than a traditional mortgage loan. His contract carried a 10% interest rate, and the price of the home was roughly 5 times what the company had paid when they acquired it from Fannie Mae. Mr. Anderson made substantial repairs to his home. He repaired the roof, replaced bursted pipes, painted, installed gutters. He paid faithfully on the contract for years. He also paid property taxes and homeowners insurance, only to discover at a certain point that the deed to the house was not in his name, and Mr. Anderson was at risk of losing all of his investment in that home. Mr. Anderson had entered into a land contract, also known as a land installment contract or contract for deed. These are seller finance transactions that are targeted at consumers who are unable or believe they are unable to get a mortgage loan. Land contracts essentially involve seller financing in which the home buyer promises to pay a fixed amount of money at a certain interest rate over a period of time, often 20 or 30 years. But unlike a traditional mortgage loan, the deed to the home remains in the seller's name until the full purchase price has been paid. And if the buyer misses a single payment at any point in time, the contract can be canceled, and the seller can keep all of the money the consumer has paid and all of their investments in the home and kick them out like a tenant. Buyers essentially have all the responsibilities of home ownership and none of the rights or protections. Another similar type of transaction is a lease with option to buy. A lease option transaction involves 2 separate contracts, a residential lease and an option to buy the home for a certain price within a certain time period, usually 6 to 24 months. And until the option is exercised, the consumer is a tenant. However, the contract often says that that tenant has to make the necessary repairs to the home, which violates landlord-tenant laws in almost every state. The consumer is often or usually required to pay a substantial option fee between $2,000 and $5,000, sometimes even more than that is non-refundable if they don't exercise the option. And most of the time, the consumer is not able to exercise the option, either because they still can't qualify for a mortgage loan within that limited time period, or because the price that they have the option to buy the home for is way above the fair market value, and no bank will make a mortgage loan for more than fair market value. These transactions are problematic because they are designed to fail. Sellers actually make more money when consumers default because they don't have to do a foreclosure sale. They just take the property back and keep all of the money the consumer has invested in the home, and they can turn around and get another consumer into the home, taking another large down payment or option fee. NCLC estimates that the failure rate for these transactions is well above 50%, and that's compared to a roughly 1% foreclosure rate for FHA mortgage borrowers. And this is a conservative estimate because some data suggests that the failure rate is really 70 or 80%. There was a study out of Texas that showed a 70% failure rate over a 20-year period. And there's also data from a Pennsylvania AG lawsuit that looked at transactions over a 6-year time period and found that 73% of those transactions had already failed just a few years later. When these transactions fail, consumers are much worse off than they would have been if they had just been renting. They lose that large down payment or option fee. They usually have been paying more than typical rent. They've spent their money and sweat equity to make repairs to the home, and they often end up facing a judgment or a collection account that ruins their credit. There is a patchwork of state laws that applies to these transactions. Many states have no protections at all on the books. Some states require a foreclosure, others require the contracts to be recorded, but all in all, many homeowners are completely unprotected. And as I mentioned, instead of offering a pathway to homeownership, these transactions really are a costly and harmful detour from homeownership for these consumers. Thank you, and I'm happy to take any questions.
Thank you so much. We will turn now to Beth Goodell, who's joining us remotely.
Good afternoon. Good afternoon. Thank you. From Minnesota, Chairwoman Smith, Ranking Member Lummis, and members of the committee, I'm happy to have the chance to talk with you today. I'm a lawyer at Mid-Minnesota Legal Aid in Minneapolis. Mid-Minnesota Legal Aid provides free legal services for low-income residents of a 22-county area. We serve clients whose household income is in the range of 125% of the federal poverty level, or about $37,000 a year for a family of 4. In Minnesota, land contracts are referred to as contracts for deed. The people who seek our help do not, of course, represent contract for deed success stories. In our experience, contracts for deed are a vehicle for exploitation rather than a path to ownership. And we have seen the abusive practices that Sarah Bowling-Mancini just described. I see the losses experienced by our contract for deed clients falling into 2 main categories. First, the loss of the protections of landlord-tenant law, and second, the loss of money paid into the home with no path for recovering it. The first type of loss is experienced by people, in our experience, who had no chance from the beginning of paying the purchase price in full and becoming the owner of the house. We have seen scores of cases where the so-called buyers had the means to rent, but not the means to buy, but the owner placed them in a contract for deed, allowing the owner to avoid responsibility for repairs and maintenance. In one case, our client had rented from the owner for years. The owner was facing the loss of his rental license because he failed to make the required repairs. On the eve of the loss of the rental license, the owner talked the tenant, a senior woman of color with developmental disabilities, into signing a contract for deed. He put the sale price into the contract at $180,000, although the accurate fair market value was about $60,000. The monthly payment stayed the same, but the seller was legally no longer a landlord. He allowed the house to fall into further disrepair. The tenant remained in the home for another 3 years before the owner brought an eviction against her for not paying the $180,000. We found that this same property owner had sold many properties this way and that none of the transactions resulted in ownership. In the end, all of the properties were taken back by the seller. The second type of loss, the loss of a significant amount of money that was paid in the house, Sarah Bowling-Mancini talked about to some extent, and Senator Smith mentioned the pattern that we're seeing in Minnesota now. of Somali immigrants being talked in to abusive contract for deed transactions. One of these transactions that we know about, the buyer had, the family had put $73,000 down and then struggled trying to make the monthly payments of $4,800. If they default on those payments, there's no requirement in Minnesota law that they get any of their money back. Another case involved a single Somali woman who paid $35,000 down and was able to make the monthly payments, but she could not find an insurance company that would insure the house. Having insurance was a term of the contract, so she was facing termination of the contract and loss of the money she paid. Now, a buyer with a mortgage who faces insurmountable financial difficulties would have time to sell the home and receive any equity over the debt owed. But this is not the case for contract for deed buyers here in Minnesota. Minnesota law requires only a written notice of default and a 60-day period for curing the default. At the end of the 60 days, the contract simply terminates, and the buyer has no right to any home equity, to the return of any payments, or the value of any repairs paid for. All of the contract for deed buyers represented by MMLA were part of a vulnerable population, low-income households. For many of our clients, their best interests lie in the availability of affordable, decently maintained rental housing rather than being pulled into contracts for deed. And because of the overlap of poverty and race, low-income communities in our service area tend to be neighborhoods where a majority of the residents are people of color. Unscrupulous sellers of contracts for deed tend to target these communities, and most of our contract for deed clients have been people of color. Contracts for deed don't always fail, but they fail low-income, vulnerable populations too frequently to allow the situation to go on as it is. Thank you for the attention you are giving to this issue and for the opportunity to talk with you about it today.
Thank you very much. And now we'll turn to Mr. Green.
Thank you, Chairwoman Smith, Ranking Member Lummis, and esteemed members of the committee. I serve as Managing Principal of Black Star Stability. Black Star is a real estate investment management company that focuses on stabilizing communities by expanding the equitable ownership of affordable single-family homes. In particular, we focus on the naturally occurring unsubsidized segment of the property market that's $100,000 or less, and that often is transacted by unregulated predatory financial instruments. We're a private equity fund that changes the lives of working class families by turning land contracts into real mortgages. In my testimony today, I'll share two important findings. First, that there's an immense unaddressed problem, and second, that there are readily available answers. Blackstar purchases pools of homes encumbered by predatory forms of seller financing, converts the financing into traditional mortgages at fair market terms, and eventually sells these mortgages and then recycles the capital. In that process, ownership is transferred to families in a transaction that is transformational. Blackstar's focus is on contracts for deed, CFDs, and similar instruments that confer the obligations of home ownership to buyers without the benefits, and take typical landlord obligations and force them upon buyers and tenants. There are more than $200 billion of CFDs, and that prevalence reflects a larger problem that the availability of small balance mortgages simply does not meet the demand from qualified buyers. Nationally, less than 30% of all properties that are sold for less than $70,000 are financed with a traditional mortgage. Notably, the supply deficit of these mortgages is driven much more by the high fixed costs and unfavorable economics of originating these mortgages than any issues of creditworthiness or financial wherewithal amongst the qualified buyers. This issue disproportionately affects low-income and minority communities. This gap has made working-class housing markets far less liquid, depressed home ownership, robbed communities of hard-earned equity, and diminished both the capital and incentive to reinvest in these communities. Unequal access to traditional mortgages has been a reality throughout U.S. history. The absence of available mortgages gives rise to products like CFDs. Blackstar's aim is to preserve affordable single-family housing, lower the cost of ownership, and keep families in their homes. Blackstar's approach uses scalable, market-driven, common-sense tactics to refinance homes for families that have been solid payers of higher-cost alternatives. Inherently, There's a strong sustainability thesis as we avoid the functional obsolescence of homes and help meet a huge shortage of affordable housing nationwide. As proof of concept, Blackstar acquired a portfolio of 181 homes in 18 states encumbered by CFDs and lease options. To date, we've converted 86 of these to mortgages and 10 more, received full payoffs for 10 more. Beyond the strong expected financial returns, the impacts are striking. There's been dramatic wealth creation. More than 85% of the families that we've been able to refinance have had equity transferred, averaging $43,000 per family, a more than 20x increase in their net assets on average. 13% of families had their principal balances reduced by nearly a quarter. Average monthly payments were reduced by nearly 30%, and penalties and arrearages were forgiven for over 40% of families at roughly 3x their net assets. The median household income for these families was $45,000, roughly 60% of AMI. As an example, in Canton, Illinois, Blackstar worked with borrowers who are a disabled veteran and his daughter, who's also disabled. They share a small multi-generational house that includes young children. When Blackstar purchased the house, it had no central heating, no hot water, and the roof leaked. The borrowers had stopped making payments due to the condition of the home and broken promises of the seller. The veteran borrower is also an amputee and was unable to accept help from a local veterans group to adapt the home due to not having title to the house. Blackstar provided a new roof, furnace, and hot water heater. The borrower's disability incomes qualified them for a new 30-year mortgage with a 30% reduction in monthly payments and the opportunity to complete the necessary accommodations to the home. By purchasing assets at a substantial discount from market-driven sellers, Blackstar can rethink the service delivery model for originating and servicing small balance mortgages. Perhaps the largest challenge that Blackstar faces is simply finding the CFDs and lease options. While we know that there are millions throughout the country, very few are recorded. Even in states that require recordation, compliance is spotty and enforcement is virtually non-existent. The owners selling these properties via these contracts are overwhelmingly intentional about staying in the shadows and rarely sell through transparent mechanisms. There's a clear and better path than the limited pool of options and minimal protections afforded to low-cost home buyers today. Small balance mortgage lending that reaches underserved consumers and communities should be meaningfully incentivized. Consumer protections must be enhanced and enforced, and recordation of CFDs and lease options must be required. In conclusion, the current state of affairs is not inevitable. Our model works. It's a simple, effective approach that earns an attractive risk-adjusted return for investors while producing life-changing stability and lower payments to families. Blackstar Stability is creating the sort of home mortgage alternative for working-class families that is already available to mainstream America. Fair and equitable access to the housing finance system is both good policy and good business. I look forward to your questions.
Thank you so much. We will now turn to our round of questions from committee members, and I will defer first to Senator Tester, who I believe is joining us remotely.
I am, and I want to thank you, Madam Chair, for your courtesy, and I want to thank you and Ranking Member Lummis for holding this meeting, and I want to thank the panelists for their testimony. As Senator Lummis said in her opening statement, I think I concur with, from a Montana perspective, this isn't something we're hearing about the way you are in Minnesota or in Michigan. And I was wondering if this is part of because of consumer protections in the Montana Code. So this question is for you, Ms. Mancini. Are there appropriate protections state can make to make sure that the market works without a bunch of folks who should have a special place in hell?
Thank you for the question, Senator Tester. There are state laws that can be effective, and of course, there also could be federal legislation that would help to rein in these abusive practices, that you allude to. Certain states, to date, some states have treated these transactions like a mortgage loan and required foreclosure. Those include Florida, Oklahoma, and California. There are a few other states that sometimes require foreclosure if the consumer has paid more than a certain amount already, and that includes Ohio, Indiana, Illinois, Maryland, Maine, and Texas. And there are some other protections that can be meaningful. Requiring recordation of contracts can be very helpful. Iowa, Maryland, and Washington require the contracts to be recorded. Of course, you have to have sufficient remedies so that the companies will comply, because there's widespread non-compliance even in states that do have a recording requirement. Other important protections are things like limiting or prohibiting other liens on the property, because sometimes buyers in a contract for deed don't know that there's a higher priority mortgage or tax lien that could foreclose at any time. So it's much better if if it's not permissible to have higher priority liens there. And then there are some habitability requirements, actually requiring the property to meet a livable standard of habitability is also a very important protection that exists in Virginia and in some local city ordinances.
Appreciate that answer. One of the things we are seeing in Montana that I think is similar is bad actors buying up manufactured housing communities, and then once they buy them, they jack up the lot rent because they can. And now these are folks that own their own manufactured home, but they don't own the land that lies underneath them, so they're stuck. I know that Montana isn't the only state where this is a problem, with purchase of mobile home communities that in fact hurt the elderly, hardworking families. Folks have been there and it's been their home for a long, long time. What we have seen, and this is for you, Ms. Mancini, again, we've seen some success with resident-owned community conversions in Montana. Could you talk about this and tell me what we could do to help those communities?
Thank you, Senator. I'm so glad you raised this issue, because you're absolutely right. Buyers in a land contract are in an even more precarious position when they are buying the manufactured home, but they are renting the land underneath, which happens quite a bit all around the country. And when those when the owners of the land jack up the lot rent, that consumer is out of luck, because most of these homes cannot be moved. They will fall apart. So the rights to actually purchase the manufactured home community is an extremely important protection, the opportunity to have resident-owned communities. And I believe there have been some good state law reforms around the country. There's also the Price Act that helps to fund that process for resident-owned communities as an affordable housing measure. So I think that's a very important step, and more could be done there.
And Beth and John, would you like to respond to that question on resident-owned community conversions? You don't have to if you don't want to.
Thank you, Senator Tester. I am aware that in Minnesota, the Attorney General's office is working on stronger protections for purchasers of manufactured housing. In the community in which I live, a housing tract was sold to a new owner who then tried to put in rent increases on the land, but the Attorney General's office stepped in and prevented that, and is now working on a set of laws that would allow for owner purchasing of the land and greater protection for the residents.
Thank you. John, do you have anything to add?
Yes, just briefly, all I would say about it is I would point out the fact that not owning the land subjects families to a range of higher costs, higher fees, higher interest rates, by virtue of being subject to chattel loans as opposed to being able to finance these as typical home purchases. It limits the options that are available. So again, by virtue of having the opportunity to purchase the land, owning that land is the fundamental difference between being able to finance a manufactured home as a site-built property. So there are important protections to provide.
Thank you for the hearing, Madam Chair, and I yield back.
Thank you, Senator Tester. Senator Lummis.
Well, thank you, Madam Chairman. I'm going to start, Mr. Green, with you. I want to make sure in my short time that you have the opportunity to share all of the recommendations that you would make to us, and further encourage you to make the same kind of presentations to either the National Governors Association or to their groups. There's a Midwestern Governors Association, there's a Southern Governors Association, there's a Western Governors Association. Some states belong to several of those, but almost everybody belongs to the National Governors Association. The governors need to hear this too. And so I strongly encourage you to make use of that venue. That said, please use as much of my remaining 4 minutes as you feel you need to give us more ideas about what the solutions are, the answers to this big problem.
Thank you so much, Senator. I would say we have an array of responses, but I think the most impactful things that we can do are to be able to identify these contracts where they exist. And the recordation plays such a huge role. It cannot be overstated that being able to enforce contract law requires the recognition of where these properties are, who the owners are, and who the counterparties that can be dealt with. For us, having the capital to be able to provide, but not knowing how to reach potential sellers is corrosive.
Did you say you are in 18 states?
We're in 18 states today.
18 states.
Our pipeline today would take us into as many as 30 states.
Wow. Okay. Excuse the interruption. Go ahead.
No problem at all. I would point out that these are overweighted in the Midwest and the South for reasons that are consistent with ones that were pointed out by my colleagues. But what I would point out that some of our findings are really that at the base of any solution has to be some encouragement around how to finance, because it's not simply the fact that you cannot finance the purchase. In many of these cases, these lower cost properties have the sorts of deferred maintenance conditions that have been referred to by both of my colleagues here. And so despite the fact that we have been able to transfer significant equity to many of these families, for the same reasons that they can't get a primary mortgage, cannot tap that equity in order to make basic needed repairs. So if your house has a leaky roof, it simply needs to be replaced. You may be comfortable making your monthly payment, for instance, but completely unable to make those capital improvements. Mm-hmm. So sweat equity and other sorts of things have played a larger role than practical for many families. So creating the capacity to finance. What many families don't realize when they're on the wrong end of these lease option arrangements are that not only can they not exercise their option because perhaps the house is overvalued, but because there simply isn't a mortgage that's available. There's no lenders. It requires a lender essentially the same work to underwrite a $500,000 mortgage as a $50,000 mortgage, and so the industry tends not to produce enough of the latter.
Okay, so could we focus on that for just a second? Because in Wyoming, I find that most of our banks are state-chartered community banks. They're small banks.
Sure.
And the more requirements that are placed on them by us federally, the harder it is for them to spend the time, the paperwork, to do those small mortgages. And so they just decide not to. And then people are shifted to these contract for deed type situations because the banks are excluded from the transaction. They don't need a bank. But then you have some unscrupulous private financiers that we've been hearing about during this hearing. So you are that alternative, it sounds like. Your company, Blackstar, tries to identify those contracts for deed and get them back to a product that is more like a traditional mortgage. Am I stating that fairly?
That is actually a traditional mortgage.
Okay, so your number one request would be to be able to identify these contracts for deed so you can approach the person who is subject to the contract.
Yes.
Okay.
Yes. So the number one certainly is the recordation so that we can identify it. I would say enforcement actions. Many states do have laws on the books that would take the teeth out of some of the sting that is provided to families who are subject to forfeiture and on the wrong end of the bad faith actions. But unfortunately, the enforcement, the advocacy tends to be poor. It tends to rely on groups like NCLC. And so unless a family raises their hand to be advocated for, then they are they're left twisting in the wind.
Yep,
So,
that makes perfect sense to me. My time is up, but I want to thank you for that. I further, if it's all right, Madam Chairman, Ms. Mancini, sounds like you have a fairly comprehensive understanding of what state laws are around the nation. And I'd ask you to provide that to the committee so that we can go through and have a better inventory of what state laws look like and which states are in need of some advice from us or something stronger than advice from us. Thank you. Thanks so much, Madam Chairman. I yield back.
Thank you so much, Senator Lummis. So I want to just start out by clarifying a bit about what's happening here with these contracts for deeds. So these land contracts basically are lacking basic consumer protections for the folks that are engaging in them. So for example, in most situations, if you are in a mortgage and you miss a payment or so, you go into, at worst case, you go into sort of a foreclosure process. This is what happens with these buyers is that they go into this immediate forfeiture, like one missed payment, and you end up kind of losing everything. Is that right, Ms. Mancini?
Yes, Senator Smith. And the key thing about the forfeiture is there is no public auction of the home.
Right.
So in a foreclosure, at least there's a possibility that a third-party buyer could pay what the house is worth and the surplus would go to that former homeowner. But with a forfeiture, the seller just keeps the house.
The seller keeps everything, and the person who's been paying in doesn't have any opportunity for any kind of redress at all.
That's right.
And then in a traditional mortgage, you would, there are certain things that Congress, I would say in their wisdom, have said are illegal activities. We learned this from the 2008 financial crisis. You can't have balloon payments. You can't have rapidly increasing monthly payments that basically price people out of an ability to own their own home. Do I have that basically right? Is that another important difference between these land contracts and mortgages?
We would argue that actually land contracts should be covered by the Dodd-Frank Act and those protections, but most actors are totally ignoring the Truth in Lending Act and all federal consumer laws. So if it's a true land contract, those laws really do apply, but they're being violated left and right, and no one is enforcing it.
So we do have federal laws to protect homeowners, including the Truth in Lending Act. But one of the challenges, and I think this gets to what Mr. Green is saying, one of the challenges that we have is we don't know where these are. We don't know who it is because there's no requirement to record these contracts in any way. Is that correct?
That's right. And even in the states where there is a recordation requirement, they're often violated. So you need, like Iowa, for example, says that if the contract is not recorded, the seller cannot enforce the contract. So that's a very powerful remedy. So you've got to think about how you do it.
Right. So not only is it not recorded, but there's no enforcement capacity.
That's right.
There. And, one thing I suspect people listening to this are, asking themselves, and Ms. Goodell, I'm going to turn to you on this, because you had an opportunity to work with some individuals who've been directly impacted by this. I think sometimes people might look at this and say, why would you enter into a contract that you don't know anything about? Or that it's sort of, the basic question is, how did you get taken advantage of, is the question. And so I'm wondering, Ms. Goodell, if you could just talk a bit about your experience with these individuals and help us understand a little bit about how people end up in these predatory and exploitive contract relationships.
Sure. Thank you, Senator Smith. My clients tend to have trusted the sellers, the people who approached them with a situation that maybe sounded too good to be true, and we know that often it is the case that it's not true. One of my clients said to me, why would this seller sell me a house that he knew I couldn't afford? And the answer that the seller would make a lot of money if you fail was beyond her understanding.
Yes.
She trusted that the seller was being reasonable.
This gets to a point that I think all of you have made in one way or another, which is that these contracts are designed to fail because that's how the seller makes more money. So the incentives are not aligned. The incentives are perverse. And that's why you have this sort of breakdown. Ms. Mancini, in your testimony, you suggested several actions that Congress could take in order to address this issue. Could you just go over those and talk to us a bit about that?
Certainly, Senator. One important piece that that everyone has touched on today is the idea of expanding access to the mortgage market for small dollar mortgages. And that can be done in a number of ways. But essentially, we need to encourage lenders to make small dollar loans, to incentivize it in a way. Even though the origination cost is the same for a $50,000 mortgage as a $500,000 mortgage, we need a system in which banks can't just say, we're not going to make loans to the low end of the market. They need to serve everyone. We also need more research on the prevalence of land contracts and the outcomes. And we need the CFPB, Consumer Financial Protection Bureau, and state attorneys general to look more at enforcement and to have the bandwidth to enforce existing laws.
Yep. I've raised this question a couple of times also with the CFPB to understand something I think Senator Lummis is also we're trying to figure out, which is what is the interplay between state and federal law when it comes to these contracts? And then, Mr. Green, I want to come to you. So anybody.
Sorry.
So, yeah,
so
okay.
the interplay. So there can be both state and federal laws that regulate these transactions. That is fine. As I mentioned, the Truth in Lending Act does apply, and it has certain requirements, but it's fairly limited in what it does. And so states do still have the ability to impose further protections, and the federal government could as well.
Okay. Mr. Green, your business seems to me to be a model that is demonstrating that it is possible to provide smaller mortgages to folks that have, in many cases, been sort of blocked out of the mortgage market in order to buy their own home. And I'm wondering if you could just tell us a little bit more about what we can learn. Ms. Mancini is talking about how Congress should be looking at ways that we could provide incentives for traditional financial institutions to offer smaller dollar loans, and but I'm interested in that, but also like what you can tell us about what you've learned from your model about how to serve this particular group of Americans.
Sure. I think part of what makes our model possible, candidly, is the discounts that are achievable in the current market environment as a function partially of some of the enforcement actions that have been taken. So state AGs have pursued, in some cases, in very aggressive manners, perceived bad actors. And what that has done has prompted more desire to sell on the part of groups that would seek to hold, as previous investors have, but also created a chilled environment for would-be buyers that depresses the pricing for that. What we're able to accomplish largely exists within the margins of those discounts. And so by virtue of taking more aggressive enforcement actions against those perceived bad actors, it helps to keep pricing for these often overpriced instruments at a level that can allow for us to absorb the cost associated with providing these smaller balance mortgages. So we have the know-how, we have the financial capability, using levers like CRA, using SBCP programs and the like, and creating the sort of levers within institutions like Fannie and Freddie to ensure that their bulk sales don't inadvertently result in huge waves of REO properties being sold that are subsequently sold via contract. Because a big part of what happened in the wake of the GFC was precisely that if we look at our own portfolio, more than 2/3 of the properties were previously REO sales from Fannie or Freddie that were subsequently sold as CFDs. And so by putting both restraints on those, constraints from that activity, as well as actual enforcement to ensure that that doesn't happen, will help to keep pricing down and allow the capacity for groups like ours to be able to finance properties.
So what you're describing is in some ways a good partnership between the public sector and the private sector. The public sector is doing enforcement. It is holding accountable these bad actor buyers. Then you are in a position with the private investment that you can make to turn those properties into a good business opportunity and, very importantly, a good place for people to live. And it basically, in that sense, is able to solve the problem.
It is, I would say it advances meaningfully toward that. I would be remiss if I didn't acknowledge the significant yeoman's effort that's involved. These are more difficult populations to serve. The geographically dispersed nature of our work requires us to have a team that has deep expertise
Yeah.
and is really willing to roll up their sleeves to accomplish it. The families are deeply appreciative. That's consistent with our mission. I think that as a practical matter, you have to acknowledge that the difficulty of serving not only the primary mortgage market, but the deep need for secondary mortgages or any sort of capacity to be able to finance the improvements and deferred maintenance issues of these properties has to be similarly addressed. And we think that there have to be incentives to help
Yeah.
prompt that.
Thank you. Senator Lummis, do you have any further questions?
I do, and thank you, Madam Chairman. And I just, Ms. Mancini and Mr. Green, if you could please, where do the credit unions fit in this? They're taxed differently than banks. They're tax advantaged. They're not for profits. So they should be able to address some of these small lending issues in a way that is still beneficial to their tax advantage status, whereas banks maybe less so because they have to factor in the tax component of their business. Why aren't credit unions helping out here?
Senator Loomis, I'll try to take a start on that. I think that some credit unions are more willing to make smaller dollar mortgages than a lot of banks, but we still don't see a lot of that. And it's something I'd be happy to follow up with and try to get a bit more insight. But I believe that the origination costs and the compensation structures, even at credit unions, tend to make it difficult below $100,000. And if Mr. Green, you may know more.
Yeah, I would concur with that point. I think that below a certain threshold, the fixed costs proportionately just make it much less desirable. And I think that inadvertently, some of the result of the qualified mortgage rules that are part and parcel to Dodd-Frank make for small balance mortgages it a little more difficult to carry those costs in quite the same way that you would in terms of the ways that mortgages are originated. And so the incentive lies much more on the other side of the ledger, particularly during the sort of market that we've had over the previous 10 years, right, where refinance activity and lowering interest rates made it much easier, much more attractive. Just the opportunity cost of doing larger loans didn't leave a lot of oxygen in the room for smaller balance loans.
So, Mr. Green, would it be advisable for us to consider a carve-out from Dodd-Frank for small-sized mortgages that provide a lesser regulatory burden and therefore a greater financial incentive for financial institutions to lend below the $100,000 level?
Yes, I think there are some provisions that exist, but I think there are some nuanced considerations to be able to incorporate reasonable cost to be able to, so that organizations like ours don't have to fully absorb the cost of doing that or disproportionately absorb the cost of doing that, and to be able to roll those into loans. I would also point out that there are also some practical dynamics in the market, things like appraisal gaps that exist given the lack of liquidity in these markets. There just tend to be fewer transactions, so pegging price tends to be harder. And so on the margins, it's more difficult to transact in this property market segment. And as a function of that, you have to do things to grease the wheels to be able to make it more likely that transactions can occur.
Do you have competition in your business model? I mean, are there other firms like you out there?
I think our competition is not necessarily firms that do what we do. It's firms that would acquire to do the opposite, right? That would hold. There's not a lot of incentive for groups, unfortunately, like the players in Minnesota who have targeted the Somali populations to sell to groups like ours after having received large down payments and having a significant equity cushion. And so for us, it's less that there are groups that are seeking to do what we do. It's groups that would acquire the same properties and seek to perform essentially what we're all here to talk about today in terms of churning families, squeezing them, and charging high interest rates to be able to have high cash yielding investments.
Are there federal barriers to the success of your business model at Blackstar?
I would say that we encounter less in the way of barriers so much as we would benefit from tailwinds that would be associated with more vigorous enforcement actions.
Okay. I may want to visit with you about this more, but we can do that offline to explore some of those advantages that may accrue to incentivize a business like yours to provide consumer information. And I might ask that as my final question, do you educate consumers as part of your business model?
We do. Part of our business model relies on trust building. We are coming in to an environment where there's, for many obvious reasons, a deficit of trust. And so a big part of what we have to do initially is to distinguish ourselves from our predecessors. And part of that is helping to educate them on the instrument that they have, the deficiencies of it, and why a traditional mortgage would benefit them, why having the headache of applying and why doing it with us is fundamentally different than the process before. So yes, that education is a big part of what we do.
Senator, I'm sorry, could I make one very quick point about QM? Is that all right?
Absolutely, if the chairman's okay with it.
Okay, thank you. I just wanted to address the question about carve-outs because I really appreciate the collaborative spirit of thinking of various options. I did just want to point out that already the QM structure has different allowances for smaller dollar loans, like the points and fees threshold and APR thresholds are higher for smaller dollar loans. So there is already a built-in understanding about those fixed costs. And of course, we should be cautious about removing key protections. I also think that a lot of the fixed costs of originating mortgages is aside from compliance. You know, there are just things that have to be paid for. But I think there is a benefit to more study about the costs of origination, the way loan officers are compensated often as a percentage of the principal balance is another factor. And there are some banks that pay their loan officers a salary in certain departments, like for community economic development, and that has led to more lending, more small dollar lending as well.
That's interesting. I was going to I appreciate that, and I was going to ask Ms. Mancini, just as we wrap up here, looking into, just to pursue this a bit more, the fixed costs associated with mortgages are the things, are partly to pay for the things that protect buyers and sellers potentially. Making sure that there's an appraisal on the property so that you're not paying 5 times more. Making sure that they're doing a title search to make sure that there aren't liens on the property that the buyer is unaware of. Could you just maybe talk a bit more about what contributes to some of that fixed cost?
Absolutely, and you've named a few. So the title search and the closing attorney will get you to at least $1,000 or $1,500 right off the bat, and those are very important. Really, no one should purchase a home without having a lawyer do a title search to make sure the person selling it actually has good title. And then, there are sometimes the inspection, there's the recording fees and the deed records. So there really are a number of flat fees that are hard to eliminate. We do know that Fannie Mae and Freddie Mac, as part of their equitable housing finance plans, have been looking closely at closing costs and with an eye towards whether any of them can be reduced.
Thank you. That's great. That's great. Well, seeing no further questions for our panel, I want to thanks so much to our witnesses for being here today and for providing testimony, both those of you in person and also Ms. Goodell calling in remotely from Minnesota. I'm interested in the conversation today. We are hearing a lot about sort of the interplay between state and federal law and how that can work together, how it really should be supporting each other. What we can do to try to make it, address the incentives around providing mortgages for smaller dollar mortgages, which would then reduce the demand for these kinds of exploitive contracts for deed. and many other, I think, good ideas for us to start thinking about. And I would like to just say that I look forward to continuing to work with our colleagues on this and work towards some common sense solutions that we can work on together.
Yeah, thank you, Madam Chairman. And I'm particularly interested in if it's not recorded, the contract for deed cannot be enforced. I think that's a really smart idea.
Yep.
So we've heard some really good ideas today, so thank you very much again for your testimony.
For senators who wish to submit questions for the record, those questions are due 1 week from today, which will be Tuesday, July 18th. For witnesses, you will have 45 days to respond to any questions for the record. Thank you again so much for your testimony. And with that, this hearing is adjourned.